Hey there, it's Bill with Smart Trades, and today is Monday, March 28th. It's just about 10:30 a.m. Pacific time, and let's get right into it. Here I have the S&P futures E-mini continuous chart, and as I've been mentioning here really for the past several weeks, I think that this decline is a corrective decline to the mid-March low. The reason for that is, once again, this triangle pattern in the B wave position, and now the depth of the reaction off of that low, I think also favors the probability that indeed this is an ABC down. We'll call it A. And if B is of similar magnitude, to A, we would expect it to peak towards the middle of April, up around the 1338 area basis the futures, about 1344 basis the cash. There's nothing written in stone that says that these need to be the same, but that is the most probable scenario. And then I show C going down. This is not correct in respect to time. It's just to give you a general view of the pattern that I'm looking for. Here's the NASDAQ. This is a 130-minute chart. The NASDAQ 100 to be exact. And again, here's what I think is an ABC down. We've got a classic 1.62 times A. That should be a small a. Excuse that. And you see the bullish divergence off the low. And you can see the rather flat but nonetheless diverging breadth ratios as we approach the gap, which is right where the market accelerated down back in early to mid-March. That comes in around 2337.50 basis the NASDAQ 100 cash. And now on to the daily S&P futures. Again, here's our count that we've been showing for some time. One up and then two down, which is a zigzag. Now, if two is a zigzag, the tendency is that wave 4 is either going to be a triangle or a flat. And this gives you kind of a generalized pattern of what we might expect if indeed it is a triangle. And a note, I have a 1365 target noted for wave 5 if indeed this all plays out. If we have a triangle, it's likely that we actually could go a little bit higher. I would push it up to the upper end of the range that I mentioned, up around 1380. On the other hand, if it does work out to be a flat, and there's no way to know how this is going to work out quite yet, but here's we have a couple of roadmaps for the future, if you will, on how it may work out. And if indeed we go up and test, say, 1344 on the cash, go down and test the lows down around the 1250 area in the cash, about 1239 on the futures, then likely this is an ABC. It obviously needs to hold fairly close to the bottom of the A wave. If it doesn't, then we've probably got a larger scale correction, and my count is wrong. But again, if we do carve out a flat and we hold close to the March lows, then the target ideally is 1365 basis the cash on the S&P. Here's a little bit more detail and a little bit of a concern here. We're starting to get up close to that breakdown point, as I mentioned in the NASDAQ. Same on the S&P. For now, the breadth ratios, this is a proprietary breadth indicator that I have, still pointing up. And that said, again, we're getting into a zone where you might expect at least a corrective decline on the very short term. An A equals C comes in right around the 1325 area basis, the futures. We're right about at resistance right now in terms of the gap that formed in the apex of the triangle in the B wave position. That comes in around 1320 basis the cash. And if we have two equal legs up, and here I've labeled it X, Y, Z. If we have two similar magnitude legs up off of the March low, that would target around 1335 basis the cash. And this is on the short term again. And that actually would fit very well with the triangle scenario. So it is worth noting both of these levels. We are getting a divergence on the advanced decline line here. And so that 1320 is the first place to watch if we power through there, and if breath reloads, so to speak, and we make new highs, then the next place again is 1335, give or take a couple of points. And finally, obviously, as stated in the first couple of slides, the 1344 area is the previous high and the target for a B wave in a flat scenario. But it's time to start looking at that at the market and being aware that we're into a zone where it may roll over. Gold. This is a chart I actually posted back on the 24th. Gold has 5 waves up on multiple degrees of scale. Here it is on the 120 minute. This again is from the 24th. And here we have a weekly chart. And basically in almost any of these scenarios, previous fourth wave support is a long way down from here. Pardon the inconsistencies in terms of the numbering, but bottom line is we have a previous fourth wave support in the low 1300s and then down around 1050. I tend to favor, if we have a top here, that I think we could go all the way back towards that 1050 area in the intermediate to longer term. So if indeed this is a top, this chart is updated through just a few minutes ago, and we have a possible 1-2 down off of that high on the 24th. The key here is that we don't take out the wave 2, or you could also label this as an ABC, the B wave peak around 1440. As long as we don't take that out, I think that odds favor that a top is in gold. You want to be careful here, obviously, with all the news in the world right now, and not so much the news, but the actual events underlying that news. I mean, this is a volatile time, to be sure, and gold could take off again. But technically, we do have a termination. We have impulse-like patterns to the downside. So risk reward here, assuming that you can get short in this range up above where we are now, and put stops either at 1440 or above 1450, assuming we're going down to at least 1300, the risk reward is not bad at all. Here's the dollar index. Again, we are looking for a possible bottom here, and indeed inverse to gold, we have a possible 1-2 forming in the dollar index. This is a 240-minute chart. That said, that the alternate count is that we have an ABC up, and that 7570 area, that's that B wave label here, that is key, just as the 1440 area is in gold. Obviously gold and the dollar, good chance they're going to go counter to each other. Again, we had looked at bonds a few days ago, looked for a possible short-term peak. I favor that this is a corrective pattern, and that we have just completed just the first portion of that. So I expect bonds to go sideways in here for a bit, but that's open obviously to review. And crude oil, I wouldn't say that I'm bearish crude, but I'm looking for somewhat lower prices as long as we don't blast through recent highs around the 106 level. I think that this possibly counts even as a top. That said, I don't have great confidence in the crude count here, and obviously I'm concerned about the situation in the Mideast. Now, this is a performance report I did with TradeStation, and it's what I did is did bullish and bearish engulfing patterns and just did a reversal system. Now this is a very easy thing to do. There's folks out there that are saying that the engulfing patterns are quite significant. The bottom line is they're really not. This is about 50 years worth of data on the S&P. There's a percentage of profitable trades is about 43%. The net profit, and this is again over I believe 48 years, is about $700. Put another way, the annual rate of return on bullish and bearish engulfing patterns is approximately 0.01%. The annual rate of return, that's not 1%, 0.01%. 1/100th of a percent is the rate of return if you used bullish and bearish engulfing patterns as a reversal system. So when somebody tells you that it's quite significant that we've had one, ask yourself or ask them if they've actually done the research on this and found out just how significant they are. I'd also like to bring your attention to the chart of Apple. I have read online that folks are using the RSI as some kind of significant indicator. If you were using the weekly chart on Apple and you were looking for a sell signal on the recent move off of the 2009 low, you would have gotten short approximately at 165. Based on, again, just using a basic reversal system on the RSI. Obviously, and there's no reversal pattern, no buy signal since then on the weekly pattern of the RSI for Apple. Again, here is a performance report. This one for the Apple RSI. This is a daily reversal. This is just using a single share of Apple, but you get the idea. You could add a couple of zeros for 100, 3 for 1,000, and so on and so forth. Net profit over, I believe this is about a 5-year study. You have a net loss, an open position loss of about $244, and a percent profitability of 50%. Now, what folks will tell you is, oh, I use the RSI in a particular way or this or that. Well, the bottom line is, as the saying goes, garbage in, garbage out. If you're using something like an RSI that, obviously, if you actually do the research, has absolutely no predictive value whatsoever. If you're using it as a comparison or as a tool for some form of scientific study, and I put scientific in quotes, you're really doing yourself a disservice. You really want to find out what these RSIs and these various candlestick patterns, what is the actual performance of these signals. It's really, these are very easy things to program in TradeStation and a variety of other programs. TradeStation's been around in its basic form since 1990. So, folks are using things like RSI, stochastic, MACD, candlestick patterns, and they're saying they have a particular value. Ask yourself, has this person actually done any research on it? Are they truly a professional researcher or trader? And my guess is if they're using this kind of information, they're not. So take it with a grain of salt. Be a skeptic. Ask questions. And that's about it for now. Hope you're having a great day and a great week ahead. Thanks so much for watching.